Okay, I'm going to carry on with where I left off last week. We're going to look at some crypto fallacies. This is part two. I'm going to deal with one that I've seen in a number of places, but let me give you some context. I have been reading some books. I've been doing my tour of the YouTube videos. Some of them are just ridiculous. The Bitcoin blogs. The book I'm reading right now, The Bitcoin Standard, the decentralized alternative to central banking. Here's the one thing I'm finding is that if you read one book, you've read everything, you've watched every video, you've read every blog. Everything seems to repeat the same talking points, and there are these few talking points, and they're taken almost for gospel, and they're repeated by a number of people. And I think that what you have is a bunch of people, a whole group of people who jumped right over understanding and landed on certainty. They're absolutely certain about what they're saying with no understanding of what they're saying, but they're absolutely certain about it. That is half the industry, it seems. I'm going to read to you some excerpts from this book about how absolutely ridiculous it is. What I find is a lot of this is propaganda. It's not there to educate you or inform you, but more to indoctrinate you. And when you're indoctrinated into a cult, you tend to repeat these few things. And no matter where you go, you see these same things repeated again and again without question, because there is no understanding. There's only certainty behind it, unfounded certainty behind it. So I'm going to deal with one first as it relates to intermediated payments, and then another one I see repeated a lot if you do your tour of this space. You'll find this one: money printing. Money printing causes inflation. Your government, your central banks are printing money, debasing your currency. It's causing inflation. Bitcoin has a fixed supply. It's a hedge against inflation. We're going to debunk that one. Both of these statements are mostly false. And when something is mostly false but sometimes true, then it's true by coincidence. If you increase something and nothing changes, increase something and something increases, increase something and that something decreases. If while you're increasing something you see it in the other thing increase, stay the same, or decrease, then it has no relationship at all. And the evidence for managing the money supply is quite dismal. So we'll debunk that. But first, let's deal with this intermediated payment thing. That is repeated a lot, the idea of a trusted third party, and that the peer-to-peer network behind Bitcoin eliminates the need for a trusted third party. You can eliminate the intermediary. And there are two reasons why that are given, two broad reasons why you want to eliminate that trusted third party. The first one, after I explain it, will be obvious to see why the crypto space is full of criminals and fraudsters and things like that. With an intermediated third party, with a trusted third party, intermediate payment, you may be disallowed from engagement in the system. Banks will, if you're trying to money launder, will stop that. If you are trying to finance terrorist groups, they will stop that. No, you can't transfer money to these terrorist groups. They will shut that down. If you are engaging in criminal activity, they will shut that stuff down, right? Isn't that what you want in your system? Do you want people to easily finance terrorism? Do you want criminals to have the same access to the banking system and have an easy life of it? Or would you say, look, make it hard on them? These fraudsters, make it hard on them. Don't make it easy on them. Make it hard on them. They're disallowed by the trusted third party. Now, most of the time when you come across this, it just says you may be disallowed. Okay, let's get it straight. Who is being disallowed here? Are a few good, innocent people being disallowed every now and then? Sure, but that's the price you pay. Are there innocent people in jail? Sure, but there's a hell of a lot of guilty people in jail. No system is perfect. There are always trade-offs. I don't want these people in the system. But Bitcoin, you want to finance a terrorist organization? Come on in. You want to launder some drug money into the system? Come on in. You're a fraudster and you want to defraud people? Come on in. You're engaged in crime? Come on in. Any pedophiles in the line? Come on in. You're welcome here too. Anybody allowed. Anybody. This is probably why you have such a large concentration of undesirable people in that space. But let's get to the trusted third party. And let's look at the rhetoric. The rhetoric is how you word something it will determine the type of message that you're trying to get across or what it is you're trying to say. Here is the argument for the elimination of a trusted third party. There's 3 of them. Number 1, a trusted third party is an added security weakness. I see this as security strength, but it's an added security weakness. New possibility of theft. The trusted third party could steal from you. You may be vulnerable to surveillance and bans by political authorities without really saying what those bans are. Again, if you're financing terrorism, yeah. If you're engaging in large transactions, that's usually the footprint of money laundering. Yeah. I mean, if I'm doing nothing wrong, what do I care? What the hell do I care, right? If I'm leaving certain footprints and it looks like the same footprint somebody else does, I want to be distinguished from those footprints. I don't mind showing my work. I bank in 3 different countries in 4 different currencies. And the toughest country to bank in is Costa Rica compared to Canada and the US. Every time you move money into your account, you must show source of funds. Why? Because they're trying to eliminate all the money laundering. I'm fully okay with that. They're trying to eliminate the fraud and the crime. I am okay with that. I want the trusted third party, but no. New possibilities for theft. Vulnerable to surveillance and bans by political authorities. This one here, intermediate payments always include the risk of fraud. Look, any human interaction includes the risk of fraud. Any human interaction. Dating sites include the risk of fraud, for God's sake. You don't have to go. So they've created this imaginary enemy in the trusted third party. They've raised the level of fear in you to make you doubt it. Oh, I should be afraid of this. More theft. They're going to steal from me. They're going to defraud. There's surveillance from political. I may be disallowed. Oh my God. They've turned what is an asset, the trusted third party, into an enemy. The trusted third party is your friend. A charge appears on your credit card that you didn't do. You call them up. I didn't do this. Or even better, there's a charge on your credit card that you did do. You bought something that somebody said is this. And you said, fine, I'll take it. But when you got it, it was something completely different. You can call your credit card company and say, this is not what I paid for. Gone. Not on Bitcoin. Why? Because that's where the criminals are. The criminals are there. If you're disallowed from a trusted third party, there is a reason. Most of the 95% of the time, 99% of the time, society doesn't want you. And the trusted third party is just doing a good job. It's a trusted third party, which is an asset. They cast it as a liability. That is indoctrination. And almost everywhere you go and almost everything you read always shits all over the trusted third party. I want a trusted third party. So do you. So do most of the people in the world want a trusted third party. I have never had any of these problems in all of the trusted third parties I've used, and I've used a lot in 3 different countries. I've used a lot of trusted third parties. They've never stolen money from me. They've never defrauded me. And when there is surveillance, you know what the surveillance is, and you know what the reason for that surveillance is. And if you're doing nothing wrong, it's like, okay, I don't mind showing you. If I was money laundering, I'd be saying, God damn it, I can't get into the banking system. This crypto thing sounds really interesting, though. If I were money laundering, if I were a fraudster, if I were a criminal, if I were funding terrorism, what a great system. But when they tell you not to trust that the trusted third party is the problem, no. The trusted third party is the solution to a world in which fraud is everywhere. You don't have to go to your bank to be defrauded and being stolen from. That happens everywhere. If anything, these places protect you from that. They have the security to protect you from that already. I want a 1-800 number to call. I want a trusted third party. It's an asset, not a liability. All right, let's get to this other thing. Money printing causes inflation. And Bitcoin is a hedge against inflation. I see this in a lot of places, the quantity theory of money, and the conclusion. It's really just the conclusion that's stated. Anybody can clearly see that an increase in M leads to an increase in P if you hold V and Q constant. Well, duh. I mean, okay, what you're doing is you're putting in some ridiculous assumptions that just aren't true in the real world, and it misses the point. You don't understand how theory is built. This is a theory. This is the quantity theory of money. And how you build theory is you construct a perfect world first, and then you look for deviations from the perfect world. Any deviation from the perfect world must be because of the variables involved in the theory and nothing more. Let me give you a good example. Does your choice of debt or equity affect the value of your firm? That's a big question. Does capital structure affect firm value? If you say, well, yes, I say, well, how? How? Is it small cap? Is it mid cap? Is it large cap? Is it in high interest rates or low interest rates? Like, there's so many variables that you would look at, it would be overwhelming. The first thing in building the theory, your theory is capital structure affects firm value. Your first step, and this is being done by Modigliani and Miller, your first step is to construct a perfect world in which it does not. You say, well, what would I need such that it wouldn't affect? Well, no taxes. That dividends are irrelevant. Whether a company pays dividends or not, irrelevant. No information asymmetry, no agency costs. So you come up with a short list of things, and they came up with a list of 6 things. And they said, okay, look, if these things were true, then capital structure would not affect firm value. There we go. So we know it does, so it can only be these 6 things. Because if we assume these 6 things, we get rid of the relationship. So if there is a relationship, it's only these 6 things. That's all this is doing. All this theory is doing is saying, look nowhere than these variables. So let's first of all construct a world in which an increase in M results in an increase in P. Number 1, let's hold V constant. V is not constant. But let's hold V constant because we have to make the perfect world first and then look for deviations from the perfect world. Q as exogenous. Well, we know that that is not true. The level of money in the system also is a determinant of the level of GDP. And I can make that argument very easy. So the idea behind monetarism is you manage this, M, to manage this, P. M is the money supply. Specifically, it is the money supply in circulation. Central banks do not create that M. They create reserves. When a central bank engages in open market operations by buying bonds in the open market, they create bank reserves. That is not money in circulation. Not until a bank lends it out is it part of the M in this equation. So it is your demand for loanable funds that increases the money supply or puts pressure on the money supply to go up. If nobody asked for a loan, the money supply wouldn't increase. So in essence, it is actually serving a function for you. You got a mortgage? Well, you're part of the problem. Really, within the confines of this theory now, you're part of the problem. V is velocity. P is the price level. Let me change that on the fly. That should be Q. Q is real GDP. The combination of these two is Y. We got to get our algebra letters right. So you manage M to manage P. I don't think that's not a controversial statement. Anytime you manage the supply of something, you do affect the price. De Beers controls 80-90% of the diamond mines in the world, and there's no shortage of diamonds, by the way. There's shortage of diamonds in circulation because they manage the supply of it. They leave most of it in the ground so that it does have the value it has. OPEC. OPEC used to be more powerful than what it really was, but it represented the petroleum exporting countries. When they were a significant factor, they didn't like the price of oil. They would cut supply to change the price of oil. You manage supply, you manage the price. That seems to make sense. Let's manage the supply of money to manage the price of money. Very linear and very causal relationship. It does not, within it, take into consideration the trade-offs. And in a complex system, because that is what we have, there are always trade-offs. You have to think about the trade-offs. And I'll show you what the big trade-off here is shortly. So here is what monetarists advocated, a constant growth in M. They did not. Monetarists did not advocate a fixed M, but a constant growth in M, leading to a constant growth in P. They also did not advocate no inflation. They did advocate a moderate level of inflation. You can have a moderate level of inflation if you have a moderate level of growth in the money supply, holding growth in Q constant. Did not work well in practice. This was in the 70s. The Federal Reserve was monetarist, managed the supply of money. Did not work out well at all. Even Friedman later acknowledged that the theory did not work out as well as he had hoped. Simply because in the real world, V is not constant and Q is not exogenous. So the theory, if we're working with pure theory, this is what we would say. If we see an increase in M and we do not see an increase in P, it must be because of V or Q. That's the takeaway. That's the takeaway. The takeaway is not an increase in M leads to an increase in P. No, sometimes it does, sometimes it doesn't. Sometimes it leads to a decrease in P because you have V and Q. Here's the big problem with this equation. There is no demand in this equation. You have supply, but where's the demand, right? Demand is held constant. V is the demand. Change in D is a change in V, and that is held constant. So think about an economy where unemployment is decreasing. People are getting jobs. And people in here say, well, now it's time to, maybe buy a new car. Maybe buy some durable goods, maybe get a house. So what do they want? They want loanable funds. They want to get a mortgage. Now it's the time to upgrade, maybe buy a car. They want loanable funds. That increases M. It is that increases M. If you disallow that from happening, you disallow growth. Because if they cannot get a new car, then a new car is not made because they can't afford it if they can't get financing. If you don't have a mortgage for a house, well, then a house is not allowed because you can't get it. So if you control M, what you're saying is we're going to control the amount of cars and new houses that are built simply because it is commercial banks that determine the level of M. So you're basically saying we're going to control the amount of money that central bank or that commercial banks can lend out. You are basically controlling growth at that point. You are basically holding growth back. But what if you could increase the money supply without any increase in inflation? Wouldn't that be a better way to go? You watch it happen. You say, okay, as soon as you start seeing inflation show up, you say, okay, now we should do something to rein this in. As opposed to have it in ahead of time, it ignored demand for money. And if you fix the money supply, you really screw up the economy. So this didn't even work well. What central banks did is they switched from a linear function to a complex function that involved a trade-off. This is the Taylor rule. So rather than managing the supply of money, they managed the price of money. The price of money is the interest rate. That is the price of money. Why? Because if you need to get $1 from me, it's going to cost you something to get that $1 from me. That is the interest rate. The price of money. And when money has a price, it also has a time value, the time value of money. And if you understand the time value of money, you understand that almost anything anything can be a hedge against inflation, for God's sake. Almost anything can be a hedge against inflation. If you stick money in your pocket and you say, well, it's not holding its value, it's like, well, come on. I mean, you're missing the point of the price of money. The price of money is your hedge against inflation. Anyways, here's your trade-off. Here is your output gap. Here's your inflation gap. Here's your inflation target. Here's where inflation is now. Here is your potential GDP. Here's where GDP is now. And we have a trade-off. This is full employment. This is price stability. There are the two mandates of the Federal Reserve. These are trade-offs. That takes into consideration a complex economy. If we have an economy performing below its potential, we don't have full employment. There are people out there who want jobs, who want better lives, and there are people out there who want higher paychecks. How do we get that done? Well, we encourage more economic activity by lowering the price of money. If we lower the price of money, we increase the demand for loanable funds. We increase the demand for loanable funds, more cars, more appliances, more furniture, more houses. If inflation is running too hot, well, we better raise the price of money so it lowers the demand for loanable funds, fewer cars, fewer houses, fewer appliances, etc. And that'll take inflationary pressure off. Manage the price of something, let the supply take care of itself. In fact, you're not even managing supply at this point, you're managing demand. When you manage supply, you end up with all sorts of problems. Let's have a look at some charts. Okay, let's start with M2. This is the M that fits the definition in MV equals PQ. And you can see that it has increased over time. This increasing over time is a good thing. If you laid this over the growth of a nominal GDP, you'd see it tracks very well with nominal GDP. And then you had this throughout the 2000, from past the great financial crisis onwards, you had a nice increase in the supply of money over time. And by the way, during this period of time, you had almost no inflation. In fact, you had a few bouts of deflation in the US while the money supply was increasing. So it cannot be true that an increase in the money supply leads to an increase in the price level. You had this massive increase in the stock of M2 and a bit of a decrease over here until we're back on what seems to be a trajectory. The slope of this line is less than the slope of this black line. So at some point in the future, they will meet, meaning that the extra stock has been worn off over time and is right where it should be if we stayed on the same trajectory. So just so that we can see that M2 pretty much increases, right? All right, let's look at velocity. Is velocity constant? Doesn't look constant to me. Look at that, peaked at 2.2 in the about 96, 97, straight down to 1.5, and we're currently at this point in time below the 1.5. If you go back in time, Friedman mid-70s, when he was observing, you could be forgiven for thinking that the velocity of money was fairly constant, because it did hover in around 1.7 up to 1.8, down to maybe low 1.64, 1.65 up to 1.8. Tight range, but then it really went after that from the mid-80s to the mid-90s up to 2.2 and then straight down. This is lining up with the generations. That's about the peak period of time where boomers were about 45, 46, a very large generation. Spending usually peaks around 45 because usually the house is bought, the furniture is there. You're not changing your vehicles every couple of years, and the kids are out of the house and gone to school, gone to university. So household spending usually peaks around that time and then drops. And you could see it significantly dropping off here until you hit, you start to see the boomers retiring from 2010 onwards. You really see the continuation and the drop in the velocity of money. So there is a change in velocity over time. Keeping it constant warps the conclusions you get. Keeping it constant is only in a perfect world. So this does change over time. Let's look at how, let's see, we looked at M2. Let's look at this one here. This is another way of looking at M2. This is the change. This is a percent change from a year ago. because you are hearing claims out there, especially from sailor money supply increases at what, 15%. Here's 15%. Only once in the last 45 years really did it breach that amount, and that was during the pandemic. And to correct for that, you actually had negative growth over here. Even saying that it grew at 10%, only in times of stress did it grow at 10%, and this is where you want to see it in recessions. Milton Friedman even said one of the exacerbators of the Depression was a policy mistake from government by not increasing the money supply. Had they increased the money supply, they would have made it easier, or it wouldn't have been as bad. But they didn't increase the money supply, and that is what happens with a fixed money supply. Is you end up with very bad outcomes. The growth is usually around 6%. Long-term average usually around 6%. Sometimes it's higher, sometimes it's lower, sometimes it's higher, sometimes it's lower, sometimes it's higher, sometimes it's lower. But the attractor point is right around 6%. But in most of the places that are pro-crypto that have actually brought up the growth in the money supply, I've seen numbers from 10 to 14 to 15%, and it's just not true. It's about 6%, which is about the growth of nominal GDP. Let's have a look at GDP. GDP is in here somewhere. There we go. Here's real GDP. If you go back to 55 to about 65, it would peak up around 8% with an average somewhere around 6%. If you go to the next decade, it would peak around 6% with an average somewhere around 4%. If you go to the next decade, it peaks around 5% with an average of around 3.5% to 4%. And now it's peaking at around 3% with an average somewhere around 2%. That's about the Fed's target when you look at the summary of economic projections of where they think the long-run trend of GDP is, about 1.8 to 2%, which is the middle of the range. We have this nice step function down from about 8% peak to 6% peak to 5% to 3%. So we have this step function down in real GDP. You have an increase in the money supply. You have a decrease in the velocity of money. And here is your inflation. We can just ignore this part in the 70s. These were supply shocks. But if we go to the 80s, you're sitting somewhere here a little over the 1% mark. This is this is quarter over quarter. There is 1%, peaking at 1% quarter over quarter, which would be about 4% annualized. Look how much lower. Look at during this period of time how low it was. This is changes in the price level, increases in the price level. In fact, you had increases in the money supply during this period of time. But look at this. Without a recession, you had 2 quarters of deflation in here. You had another quarter of deflation in here. That's very bad news for an economy. To have deflation, because with deflation, it's the same as seeing the price of your currency increase. And you think, I'll wait another couple of days, it'll go up even more, right? You're looking at your Bitcoin, 100,000. Well, look, it'll buy double what it could buy based on the beginning of the year in January is 50,000, 100,000. You could spend it now. You say, no, I'll wait for it to go higher. That's the same thing as saying, no, I'll wait for prices to go lower. It's the same thing. That is bad news for an economy right there, deflation. But there it is right there. You have a very weak relationship between M and P. Why? Because V is non-constant and Q also depends on M. I've already explained that. If you have a fixed M, you probably have almost no loanable funds, or the cost of loanable funds would be way too high. You have fewer cars being made, fewer houses being built, so real GDP drops. So real GDP is in part determined by the growth in the money supply, and the relationship between growth in the money supply and the price level is I wouldn't say quite random, but the relationship is very weak. It's not a linear relationship because it ignores V, which is demand. Let's look at Bitcoin. Here's Bitcoin. Here's the S&P 500. Notice the S&P 500. This is April 20. Here is April 20 as well. and this goes to October 24, October 24. I've lined them up as best as possible. You had this run up in the S&P, and then when inflation showed up and rates started to increase, you had this pullback in the S&P, and then you had this run up. You had this run up in Bitcoin, and when inflation started showing up, you had this pullback. Those two things look kind of close to you. This is a risk allocation, not a hedge allocation. It's a risk allocation. It just so happens to be going up with other risk assets that happen to be going up when inflation is elevated, which is just a coincidence. It's not a causal factor at all. In fact, if I overlay inflation on this, it really went like this, and then it really went up before it started to come down. And when it really started to go up, and the central bank said, okay, let's deal with this. Let's raise the price of money to decrease the demand for loanable funds. Usually when that happens, risk assets don't do well, and it did not do well. So look at the pink line, look at the white line. Did this respond more like a risk allocation or more like an inflation hedge allocation? I mean, it is what it is. It's a risk allocation. Let's stop calling it a hedge against inflation. Almost anything can be a hedge against inflation that is going up. If you last year bought US dollars, if you were in Canada and you bought US dollars, you would say the US dollar is a great hedge against inflation because it went from $1.34 Canadian to $1.43. More than outperforming inflation. The US dollar is a hedge against inflation. So on a relative basis, almost anything can be a hedge against inflation if your only measure is it went up. It went up by more than inflation. By the way, in a competitive economy that has money that has a time value, if you can't outperform inflation, there's something wrong with you. You're just not trying hard enough. Outperforming inflation is not hard to do. Now, not everybody can do it, but if you have money and you're just leaving it in your pocket or you're just leaving it in your bank account, then yeah, of course, but you're missing the point. The store of value is in the time value of money. Money has time value. If you're not going to take advantage of the value that's sitting there, well, of course you're going to lose out. But it's easy to outperform inflation. My God, it's not difficult to outperform inflation, that you have to create a whole superstructure of an imaginary currency to get it done. To me, seems like a ridiculous thing. Okay, I'm just going to get rid of the bottom part of the screen, and let's think again about MV equals PQ in the confines of that, and why fixing M would be absolutely horrific. Let's look at this Bitcoin chart over here. This is 50,000 near the beginning of 2024. We're at 100,000. Let's say at this point in time, I decided to hire you, and I'm going to pay you $100,000 of purchasing power a year. So I look at the price and say, okay, well, that's 2 Bitcoin. I'll pay you 2 Bitcoin a year. Now, we're looking at an exchange rate. So we're looking at the price of one thing relative to the price of another, which is the US dollar. So the US dollar is being held constant while the price of Bitcoin can fluctuate. I want you to imagine now a world in which there is only this Bitcoin, and we don't know what its US dollar value is, but we can determine what its real value is. And let's say this 2 Bitcoin, let's say I'm an auto manufacturer, and this 2 Bitcoin is equivalent to 3 1/3 vehicles. Each car is $33,333. Actually, sorry. Let's say it's equivalent to 3 cars. Each car is $33,300. So when I hire you, I think about, well, what is the real cost of you to me? I got to make 3 cars and sell 3 cars to pay for you. Okay, good enough. I know how much it costs me in real terms, because keep in mind now, I have no other reference if I want this to be my currency, right? If I'm looking at it in relation to another currency, I may as well just pay you in that other currency rather than saying 2 Bitcoin. I'm paying you 2 Bitcoin. And at the end of the year, we're all the way up here. And again, we need something to compare it to. I'm comparing it to a real value here, but it has doubled in value. So at the end of the year, your 2 Bitcoin can now buy 6 cars because we are leaving the supply fixed, so only the price can increase. So now we can produce 6 cars. And I say, oh, you're starting to cost me too much money because I have limited production capacity here. You cost me 3 cars of production at the beginning of the year. Now you're costing me 6 cars of production. I got to lower your salary to 1 Bitcoin. Now, if we think about in terms of dollar value, just to put that back in there, I did agree at the beginning of the year to pay you 100K. If I lower your salary at the end of the year, it's still 100K. But we don't have this reference point. We just have this real point that I look at. I, as a producer, can see what I can put out there. And now you're costing me 6 cars. I simply can't afford that. You don't want your pay cut, I'll have to fire you and hire somebody else at 1 Bitcoin. But wages, the wage level would go down. You would find it hard to get a job somewhere else for 2 Bitcoin a year because somebody would say, that's 6 cars a year. Let's say Bitcoin goes to 200,000. The value goes to 200,000, and I lowered your wage to 1 Bitcoin back to 3 cars. Now you're back up to 6 cars. I can't afford you. I got to lower your wage back down to 0.5 Bitcoin. So what are you getting when you look at wages in the economy? They're going down. You're getting wage deflation. However, it's still maintaining the same purchasing power, but you're getting wage deflation. But you may say to me after 1 year, but I'm worth more to you now. Isn't that justification for a raise? And I get that, okay, it was 3 cars, now it's 6. That's fine. But at the beginning of the year, I was earning the equivalent of 3 cars. Can I not now earn the equivalent of 3.1 cars? Am I not worth more to you? I say, okay. I have a number of people working for me who are making this argument. And I say, okay, well, out of the 10 of you, I can give 9 of you a raise, and I got to fire 1 person. Why? Because who am I going to get it from? There's only 21 million of these. You want more, you want more, you want more, you want more, you want more. Great. Where are we going to get it from? We got to get it from somebody else. It's a zero-sum game at this point. You want more, I got to take it from somebody else. Somebody has to be fired. Gone. If they were making enough, because gross domestic product is equal to gross national income. If they were making enough for 3 cars, then there's 3 cars less because you're not going to buy 3 cars more. There's 3 cars less being demanded because they don't have a job. The more, now these 9 maybe next year say, well, we want a raise as well. Well, 8 of you can get a raise and 1 of you has to be fired. And companies everywhere would be faced with this, that my experience should be worth more. But there's only 21 million of these. That no matter how much value you create, you can never increase the amount of currency in place. No matter how much we could increase GDP by, the amount of money in circulation would never change. Now think about what the cost would that be. Once you manage the supply of something, you manage the price of something. How much do you think it would cost to borrow that money? What would the interest rate be to borrow any money whatsoever? It would be exorbitantly high. It would be really high because there's only a limited amount. That's the problem with limiting your currency, is you shut down the growth in your economy. Now I'm going to layer on one more very bad thing. What if somebody came along and said, I'm going to start buying this stuff up. I'm going to start collecting this and I'm never going to share it. My velocity will be 0. My velocity will be 0. Pretty soon there'll be 20.5 million. Then there'll be 20 million. Then there'll be 19.5 million. And it will be harder and harder and harder for me over here to give you a raise because I got to get it from somebody else. I have to get it. And if this money's being taken out of the economy and being hoarded, what are you going to do? You can't print more. I got to come up with something. I got to get it from somebody else. So it becomes even tougher to find out where you're going to get your next bit of currency, simply because everybody wants more, but there's less and less and less. So you could have a few people who are very competitive in an open economy, who do very well, who control everything, and a whole bunch of people who have almost nothing. You would have massive unemployment. You would have probably a 0.1% and 99.9% kind of division like that, because you could hoard all the money. Now, your money is not being controlled by a government any longer, but it is being controlled by private individuals and private corporations. Private corporations with the expressed intent to control the supply. Do you see how bad an outcome this is going to be? Do you see how absolutely ridiculous it would be to even entertain the idea of this as a currency? It's not a currency. Stop saying it's a currency. It's not a currency. You don't want this to be a currency. The probably most ironic part of this is most of the people who are advocating for crypto tend to be people, based on their comments, tend to be people that have an external locus of control. These are the people who are the least equipped to compete in a competitive environment with a fixed money supply. They are most likely to be the biggest losers in an economy with a fixed money supply, advocating for their own destruction at this point in time. If you are having a tough time with a growing money supply in capitalism, which is competition, you're dead in the water with a fixed money supply. That is the worst thing you want. That is the worst possible outcome. If you are falling victim to the propaganda of this space, if you are believing the misinformation in this space, you are being driven into the hands of the fraudsters and the criminals. You are least likely equipped to be able to keep the money that you make in that space. You should be against this kind of thing. Rather than for this kind of thing. In upcoming videos, I will explain what part of all of this is tulips, what part of this is .com. The tulips is something we can do without. The .com, maybe there is something there because something was born out of the .com era. I'm also going to explain why, no matter how much you want to talk about your technology, no matter how elegant you think your solution is, no matter how good and solid you think it is, no matter how much infrastructure you want to point to, it doesn't matter. None of it matters. I'll spot you all the technology. I'll say, yeah, your technology's fantastic. I'll give it to you. I won't even go there. I will give it to you, and I will explain to you that it doesn't freaking matter.